G'day, my name's Nick Cregan. I'm the founding partner of Fairlight Asset Management. We started the business almost 5 years ago now. Prior to that, I was with Evans & Partners for 4 years. I was co-portfolio manager on the global fund there, alongside Stephen Arnold, who now works at founded Aorus. Previous to Evans & Partners, I spent a long time with Schroders, so almost 10 years. Launched the small and micro-cap funds for them alongside a chap called David Wannis, and was invited to work with Jenny Jones, who is one of the best small cap track records in the US. And under her tutelage, learned a great deal working on Wall Street. Been in equity markets for around 20 years, almost half of that in international markets, and have a deep passion for equity investing.
Global small caps is an area that I'm quite familiar with from a research perspective. I know it's kind of like we just talked off air about a dearth of funds that are available, high quality investment managers like yourself. Can you give us kind of like an overview of like what is the sector, and I guess why do people invest in the sector?
Yeah, really good question. And you and I have known each other for quite some time now. I think almost 4 or 5 years. I think when we first met, and we've had this conversation over a long period of time. Why are Australian investors so comfortable with global large cap and less enamored by global small and mids? I think it's really, to your point, been a lack of A, options, and B, education about the space. So global small and mid caps as an asset class is about 40 times the size of the equivalent here in Australia. So this mid cap space here in Australia, by global standards, is quite small. And as we know, equity markets, Australian equity markets make up about 3% of the global opportunity set. And so Australians' first call is when they're going offshore is to think about the big names, the Apples and the Microsofts, etc., which makes perfect sense. And it's only now that investors, especially more sophisticated investors, are moving down the market cap spectrum a little bit and considering global small and mid caps. So it's an opportunity set which we think is incredibly powerful, but it's been largely ignored by Australian investors until really the last few years. So we're trying to provide an opportunity there and educate Australian investors about exactly that opportunity set and what it means in their portfolios.
What would you consider as a global small cap?
Yeah, so global small caps and then global mid caps is where we sort of invest. The definition by MSCI sort of uses percentage of the asset class, but to frame it up with dollar terms, and this surprises people pretty often, is that a global mid cap in the US is up to $30 billion in market cap. So that would be solidly ASX 200. So people often ask us, aren't global small mid caps a bit riskier? Are the business models a little flimsier? How do they do in the tough times? Well, our answer to that is if you're comfortable with the risk of the ASX 200, you'll definitely be comfortable with the risk of the global small and mid cap market. It's really just a big asset class as compared to the Australian equivalents.
So why do people invest in global small caps and mid caps? Like, what is the appeal? Is it growth? Is it income? How do they sit in portfolios as well?
It's more about growth than it is income. So the dividend yield for the asset class sits at about 1%, and it's often, I think we'll probably get into this a bit later, but around a third of that index actually isn't profitable. So you're not investing in that space for the income. What you're trying to do is either have a passive exposure and get the uplift from the asset class, or what we're doing, which is a more targeted approach in trying to sort of eke out the hidden gems, if you like, amongst the malaise of thousands of businesses. And within that, what we're really trying to do, and what I think most investors with exposure to the index is trying to do, is try and get that growth uplift as compared to the large cap index.
What macroeconomic factors tend to influence the sector?
Well, like all equities, as we're seeing at the moment, interest rates have a bit to do with it. So interest rates are the equivalent of gravity to equity. So as interest rates are increasing, investors have an alternative to parking their assets either in cash or in equities. So they can buy bonds, or they can sort of have similar exposure. So that's going to move things around a little bit. What's kind of interesting though is that large caps and mid caps tend to move in slightly different ways depending on where the conversation is pointed in macro. So whilst global large cap and small and mid caps are correlated, there is a diversification benefit from investing in both. In fact, you can get an uplift to your alpha by having a 75-25 blend large cap, mid cap, without a demonstrable increase in your risk. And the reason for that is that global large caps tend to get buffeted around a little bit more by the conversations that you see in the media. So I think the conversations that we're currently having in, say, the US and China about the possibilities of Taiwan, that'll move global large caps around a little bit more, whereas global small and mid caps tend to be more localized markets. So it's dependent on what's happening in Texas or in London or in France for these businesses that are sort of operating in the more local markets. So there is a diversification benefit to holding both.
What is the historical return profile like for global small and mid caps? And I guess you just answered partly the kind of the risk return profile, but kind of like what's the context around that?
So the long-term returns to the global small and mid-cap market have been actually pretty attractive. So about 10% per annum over a long period of time, which depending on what time frame you're looking at, is about a 1 to 2% uplift over large caps. So that's the index return over a long period of time. It's actually the superior return to investing in large caps, which is a little bit different to the Australian investors' experience. Australian, I think it's Finland. Finland is the only other, I think, developed market in the European, US, Australian complex where this is true. So Australian investors have experienced large caps outperforming small caps over long periods of time. It's actually the opposite in most developed markets. So small and mid cap global markets have outperformed large caps. So the return profile is about 10%. We've delivered a little bit better than that. So the return profile from an active fund sits at about 12%, which marries quite nicely with the EPS profile of the fund, which has been somewhere between 12 and 15% over the last 5 years.
So global small mid caps, it sounds like there's a big market, it's a big sector. How could you cut it up? Are there subsectors of this? How do you think about that?
Yeah, sure. There's about 5,300 stocks in the opportunity set in the global small and mid cap MSCI index. So there's a lot to choose from there. And with that number of stocks, you can appreciate it's highly, highly diversified. In fact, the largest firm within that index only makes up about 30 basis points of the total index. So very, very diversified. The question is, do you want that level of diversification? So you can take two approaches. You can either have a passive approach, which is perfectly fine, average into an index over time, and you will participate in the growth of those underlying businesses. Or you can take a slightly different approach, which is to say, well, how do we maybe reduce the risk of our investing, but also participate in the upside of maybe the better businesses that sit within that index? Now, as I mentioned before, about a third of our index doesn't make any money. So it makes perfect sense to me to strip those out. Maybe they'll make money one day, but you're really buying a business model rather than a business at that point. So we strip those out, and then we had a really good look at where did the majority of the returns come from for investors over a long period of time, and we skew our investments into those sectors. So light industrials, retail, healthcare and technology is where we can find those businesses that genuinely deliver a return, a cash return on their capital invested of over 15%. And within that, we concentrate our investing pretty meaningfully. It's a bit of a reminder to investors. Sometimes they think the diversification is the one free lunch you can get in investing, which we agree with, but you don't need to be quite as diversified as people think. You get most of the diversification benefits from the index at about 20 securities, and then over that, you sort of moving down the diversification curve. We invested with a 30 to 40 stock mindset, which gives us enough diversification, but also allows our best ideas to come to the fore.
So in what ways do you measure diversification then within the asset class? You said there are 5,000 securities in the universe. How would you measure diversification?
Yeah, I mean, measuring diversification for us is a little bit different from what you get from the index. So measuring it for the index is pretty simple. There's 30 basis points is the largest stock in that index. So highly diversified by both underlying sector and by business model and by business. For Fairlight, it's a little bit different. What we're looking for is less about a GICS definition of our diversification from an economic exposure point of view, and more about sort of how do we define what our actual exposure is to an underlying subsector of the business, of the economy rather. So whilst from a GICS point of view, you might have exposure to say auto, we'll split that between sort of auto OEM, auto retail, auto auctioneer, auto insurance, and then we can understand rather than a sort of, call it a simple GICS exposure, it's more subset of the subset of where our exposures are from an economic point of view. So that's our economic exposure, but that doesn't tell you everything. You've also got your trading exposure, diversification, and there we can invest up to 40 securities. We run a 40 by 40 correlation matrix, which tells us within our portfolio where are our major exposures from a correlation trading point of view. And that becomes quite important for things like a UK-based portal. So we invest in both Auto Trader and Rightmove. From a trading point of view, the correlation there is incredibly stark, but they serve completely different parts of the market. One's obviously exposed to auto consumer, and the other is exposed to less so consumer and more the real estate market in property. But we have to be aware of those exposures. So we look at it from an underlying economic point of view and also from a trading point of view.
How about then in terms of fees across the sector? What is the range, I guess, the spectrum of different vehicles to get exposure to the sector? Yeah,
sure. I mean, you've got all the way from almost a passive exposure or a smart beta exposure. You can get passive exposure as cheap as 15 basis points. You move up the spectrum a little bit to a more smart beta approach, and you're sort of looking at 50 to 60 basis points, all the way into sort of concentrated active. And it becomes more expensive in concentrated active for the very simple reason that capacity isn't infinite. So if you're running a concentrated book, you can run maybe $3 or $4 billion in that strategy and it caps out. And so up at that range, you're looking at sort of maybe up to 1.25, 1.3% as a base fee. And then very often you're looking at a performance fee over the MSCI SMID index, or an index that a manager might choose that hopefully is appropriate for the asset class.
So how did you determine for Fairlight, your capacity constraints as a global small and mid-cap manager? How do you determine how much is too much, I guess?
We took a really conservative view here, and the reason for that is we want to keep our product super tight and super nimble and be able to outperform. We've got a performance fee attached to our product for that exact reason, so it keeps us honest from a capacity point of view. The way we came about it was less about liquidity. So to give you a bit of a look under the kimono here is essentially the fund, because it skews a little bit towards mid-cap or the higher end of the small cap market, the weighted average market cap across the portfolio has been between 11 and 15 billion over time. So the daily liquidity has been somewhere between 80 and 100 million dollars in daily liquidity. That means our fund can be liquidated very, very quickly, which implies quite a large capacity number. So instead of doing that, what we said is, look, the smallest business we're likely to own is about $1 billion in market cap, and we don't want to trigger a 10% ownership of any one fund. So we don't want to step over that hurdle, because you start getting into regulatory problems about takeover notices, et cetera, in different jurisdictions. If you wanted to own that business at an average weight in the portfolio, what does that imply? It implies about $4 billion in capacity. So we think somewhere between $4 and $6 billion is probably the number. But as a reminder, that's pretty conservative, because the weighted average market cap across the portfolio is somewhere between 11 and 15. It gives you an idea of just how conservative we've been on that. But we're very happy with that. We'd be absolutely stoked if we got to $4 billion in FUM. And I think that's a number that allows us to continue to be really nimble and continue to outperform.
Fantastic. Well, Nick, thanks for joining me on the show.
Absolute pleasure. And it's great to see you again after all these years of COVID and shutdowns.
Likewise, mate.